Trading in the Zone. Chapter 1. The Road to Success: Fundamental, Technical, or Mental Analysis. In the beginning, fundamental analysis. Who remembers when fundamental analysis was considered the only real or proper way to make trading decisions? When I started trading in 1978, technical analysis was used by only a handful of traders, who were considered by the rest of the market community to be, at very least, crazy. As difficult as it is to believe now, it wasn't very long ago when Wall Street and most of the major funds and financial institutions thought that technical analysis was some form of mystical hocus pocus. Now, of course, just the opposite is true. Almost all experienced traders use some form of technical analysis to help them formulate their trading strategies. Except for some small isolated pockets in the academic community, the purely fundamental analyst is virtually extinct. What caused this dramatic shift in perspective? I'm sure it is no surprise to anyone that the answer to this question is very simple: money. The problem with making trading decisions from a strictly fundamental perspective is the inherent difficulty of making money consistently using this approach. For those of you who may not be familiar with fundamental analysis, let me explain. Fundamental analysis attempts to take into consideration all the variables that could affect the relative balance or imbalance between the supply and the possible demand for any particular stock, commodity, or financial instrument, using primarily mathematical models that weigh the significance of variety of factors: interest rates, balance sheets, weather patterns, numerous others. The analyst projects what the price should be at some point in the future. The problem with these models is that they rarely, if ever, factor in other traders as variables, people expressing their beliefs and expectations about the future. Make prices move, not models. The fact that a model makes a logical and reasonable projection based on all relevant variables is not of much valuable if the traders who are responsible for most of the trading volumes are aware of the model or don't believe in it. As a matter of fact, many traders, especially those on the floors of the future exchanges who have the ability to move prices very dramatically in one direction or other, usually don't have the slightest concept of fundamental supply and demand after that are supposed to affect prices. Furthermore, at any given moment, much of their trading activity is prompted by response to emotions factors that completely outside the parameters of the fundamental model. In other words, the people who trade and consequently move prices don't always act as a rational manner. Ultimately, the fundamental analyst could find a prediction about where price should be at some point in the future is correct. But in the meantime, price movement could be so volatile that it would be very difficult, if not impossible, to stay in a trade in order to realize the objective. Technical analysis has been around for as long as there have been organized markets in the form of exchanges. But the trading community didn't accept technical analysis as a viable tool for making money until the late 1970s or early 1980s. Here is what the technical analyst knew that it took the mainstream market community generation to catch on to. A finite number of traders participate in the markets on any given day, week, or month. Many of these traders do the same lines of things over and over in the attempt to make the money. In other words, individuals develop behavior patterns and group of individuals interacting with one another on a consistent basis form collective behavior patterns. These behavior patterns are observable and quantifiable, and they repeat themselves with statistical reliability. Technical analysis is a method that organizes this collective behavior into indefinable patterns that can give a clear indication of when there is a greater probability of one thing happening over another. In a sense, technical analysis allows you to get into the mind of the market to anticipate what's likely to happen next, based on the kind of patterns in the market generated at some previous moment. As a method of projecting future price movement, technical analysis has turned out to be so far superior to a purely fundamental approach. It keeps the trader focused on what the market is doing now in the relation to what it has done in the past, instead of focusing on what the market should be on doing based solely on logical and reasonable as determined with a mathematical model. On the other hand, fundamental analysis creates what I call a reality gap between what should be and what is. The reality gap makes it extremely difficult to make anything but very long term predictions that can be difficult to exploit, even if they are correct. In contrast, technical analysis not only closes the reality gap, but also makes available to the trader a virtually unlimited number of possibilities to take advantage of. The technical approaches opens up many more possibilities because it identifies how the same repeatable behavior patterns occurs in every time frame, moment to moment, daily, weekly, yearly, and every time span in between. In other words, technical analysis turns the market into an endless stream of opportunities to enrich oneself. The shift to mental analysis. If technical analysis works so well, why would more and more of the trading community shift their focus from technical analysis of the market to mental analysis of themselves, meaning their own individual trading psychology? To answer this question, you probably don't have to do anything more than ask yourself why you bought this book. The most likely reason is that you are dissatisfied with the difference between what you perceive as the unlimited potential to make money and what you end up with on the bottom line. That's the problem with the technical analysis. If you want to call it problem, once you learn to identify F5 patterns and read the market, you find there are limitless opportunities to make money. But as I am sure you already know, there can also be a huge gap between what you understand about the markets and your ability to transform that knowledge into consistent profits or a steadily rising equity curve. Thinking about the number of times you have looked at a particular price and chart and said to yourself, it looks the market is going up or down as in case may be, and what you thought was going to happen actually happened, but you did nothing except watch the market move while you anguished over all the money you could have made. There is a big difference between predicting that something will happen in the market and thinking about all the money you could have made, and the reality of actually getting into out of the trades. I call this difference. It's a psychological gap that can make trading one of the most difficult endeavors you could choose to undertake and certainly one of the most mysterious to master. The big gap question is, can trading be mastered? Is it possible to experience trading with the same ease and simplicity implied when you are only watching the markets and thinking about success, as opposed to actually having to put on and take off trades? Not only is the answer or an equivocal yes, but that's also exactly what this book is designed to give you. If going to the moon represents consistent success as a trader, we can say that getting to the moon is possible. The journey is extremely difficult and only a handful of people have made it. From our perspective here on Earth, the moon is actually visible every night, and it seems too close that we could just reach out and touch it. Trading successfully feels the same way. On any given day, week, or month, the markets make available vast amounts of money to anyone who has the capacity to put on trade. Since the markets are constant motion, this money is also constantly flowing, which makes the possibilities for success greatly magnified and seemingly within your grasp. All of these possibilities sound quite plausible, except when you consider that most of the trading industry failures are some of the society's brightest and most accomplished people. The largest group of consistent losers is composed primarily of doctors, lawyers, engineers, scientists, CEOs, wealthy retirees, and entrepreneurs. Furthermore, most of the industry's best market analysts are the worst traders imaginable. Intelligence and good market analysis can the road to success certainly contribute to success, but they are not the defining factors and separate the consistent winner from everyone else. Well, if it isn't intelligence or better analysis, then what could it be? Having worked with some of the best and some of the worst traders in the business, and having helped some of the worst become some of the best, the logical answer to the question is yes. If I engage in an activity that is inherently risky, then I must be a risk taker. The successful trader that you want to become is a future projection of yourself that you have to grow into. Growth implies expansion, learning, and creating a new way of expressing yourself. This is true even if you are already a successful trader and are reading those books to become more successful. Many of the new ways in which you will learn to express yourself will be in direct conflict with ideas and beliefs you presently hold about the nature of trading. You may or may not be already be aware of some of the beliefs in case what you have currently hold to be true about the nature of trade will argue to keep things just the way they are. In spite of frustrations and unsatisfying results, these internal arguments are natural. My challenge in this book is to help you resolve the arguments as efficiently as possible. Your willingness to consider the other possibilities exist, possibilities that you may not be aware of, may not have given enough consideration, will obviously make the learning process faster and easier. Hence, the chapter 1 is over. Trading in the Zone. Chapter 1. The Road to Success: Fundamental, Technical, or Mental Analysis. In the beginning, fundamental analysis. Who remembers when fundamental analysis was considered the only real or proper way to make trading decisions?